The silver market has always been a place where signals appear long before the public notices them. Quiet movements deep inside the structure of the market often tell a story that headlines completely miss. And right now, one of the strangest signals in modern silver history is unfolding in plain sight. It is not a price spike. It is not a crash. It is not even something visible on the surface of the charts. Most people watch every day. The real signal is happening in the positioning of those who actually produce silver. For decades, the structure of the silver market followed a predictable pattern. Producers of silver would hedge their future production. When prices rose, they would sell futures contracts to lock in those high prices. When prices fell, they would reduce those hedges. It was a basic risk management system that the industry relied on for generations. But something extraordinary has happened. Producer short positions, the contracts used by mining companies and producers to hedge their future output, have collapsed to levels never seen before. Even during periods when silver prices crashed violently, these positions usually remained much higher. The system always functioned the same way. Prices go up, producers hedge. Prices fall, producers unwind hedges. That rhythm defined the silver market for decades. But now the rhythm is broken. Even as silver prices surged dramatically higher over the past cycle, producer short positions continued falling. The amount of hedging in the system didn't rise. It didn't stabilize. It collapsed. And that is the signal. Because under normal conditions, a producer looking at higher prices should be eager to lock in those prices. If the market offers them a chance to sell their future production at historically high prices, logic says they should take it. Hedging protects them from price drops. It stabilizes revenue. It gives them financial certainty. But they are not doing it. In fact, they are doing the opposite. The number of gross short positions, the raw contracts used to hedge production, has dropped to extremely low levels. Levels that historically only appeared near the very bottom of the silver market. Think about that for a moment. The last time the market saw producer positioning this low was when silver was trading far below today's price levels during one of the deepest lows in modern silver history. At that time, the metal was near the bottom of a multi-year bear market. Producers had little reason to hedge because prices were already extremely depressed. Yet today, even with prices dramatically higher, the same behavior has appeared. This is not normal. It means one of two things must be happening. Either producers cannot hedge anymore, or they refuse to hedge. Both possibilities carry enormous implications, because if producers cannot hedge, it means something inside the structure of the futures market has broken. And if producers refuse to hedge, it means the people closest to the physical silver supply believe prices are heading much higher. Neither scenario is comforting for a financial system built on derivatives. To understand why this matters, we have to understand how hedging actually works. When a silver producer hedges, they typically sell futures contracts representing silver that will be mined months or years in the future. By doing this, they lock in a price today for metal that hasn't even been pulled from the ground yet. If the price falls later, the producer still receives the higher locked-in price. The hedge protects them. But hedging only works when the futures market and the physical market are aligned. If the futures market begins pricing silver lower than the physical market, the hedge becomes dangerous. Instead of protecting the producer, it begins to generate losses. And this is where things become very strange. In recent months, the relationship between different silver markets has shifted in unusual ways. The spot market, where physical silver is traded immediately, has been trading at prices that sometimes exceed the futures market. That might sound like a small detail, but in commodity markets it is extremely important. Because if the spot price is higher than the futures price, selling futures contracts to hedge future production effectively locks in a lower price than what the metal is worth today. Imagine producing silver and being offered a contract to sell it in the future at a lower price than what you could get right now. No rational producer would accept that willingly. In that situation, hedging stops making sense. The producer would rather remain exposed to the market and sell later than guarantee themselves a loss through the hedge. And if enough producers make that decision at the same time, something remarkable happens. The supply of new short positions in the futures market begins to disappear. Normally, producers are one of the biggest sources of short contracts. Their hedges create a steady flow of supply into the futures market. Those contracts help maintain liquidity and balance between buyers and sellers. But if producers stop shorting, that supply vanishes. The entire structure of the futures market begins to change. And that appears to be exactly what is happening. The data shows a steady decline in producer short positioning, even as silver prices surged dramatically higher. At moments when hedging should have exploded, it instead collapsed. This is the kind of anomaly that only appears when something fundamental shifts in the financial system surrounding a commodity. But the silver market does not exist in isolation. Silver sits at the intersection of several massive economic forces: industrial demand, monetary demand, energy costs, currency stability, and global credit conditions. And when you zoom out from the silver chart, you begin to see that something much larger may be unfolding. Across the broader financial system, signals of strain are appearing everywhere. Commodity ratios are shifting in ways rarely seen in modern economic history. The relationship between energy and precious metals has reached levels that previously only occurred during extreme crises. Oil priced in real money, measured against gold, has fallen to extraordinarily cheap levels. Historically, oil has rarely been this inexpensive relative to monetary metals. Only during brief moments of global disruption has the ratio fallen this low. This tells us something important. The problem may not be commodities. The problem may be the currency system measuring them. When oil, silver, and gold begin behaving differently relative to paper currency, it suggests that something deeper is happening beneath the surface of the economy. Credit, the invisible fuel that powers modern finance, may be weakening, because modern economies do not run on physical money alone. They run on credit expansion, debt creation, finances, governments, corporations, wars, infrastructure, and consumer spending. Credit is the engine, and when credit begins to strain, everything else begins to move. Commodity prices shift, employment trends change, asset markets become unstable. In recent data across multiple sectors, early warning signals of credit stress have begun appearing. Debt delinquency rates in several categories have climbed to levels that exceed those seen during the early stages of previous financial crises. Credit card defaults, auto loan delinquencies, and other consumer credit stress indicators are rising at a pace that suggests households are reaching their limits. These kinds of stresses rarely remain isolated. They spread. Credit systems are interconnected webs. If enough defaults begin appearing in one part of the system, lenders become cautious. Liquidity tightens, financing becomes more expensive, and when financing becomes expensive, economic growth slows. Eventually, employment reacts. For decades, economists have noticed a pattern in employment data that appears before recessions. Employment growth slows, the rate of expansion flattens, and eventually the trend reverses. At the moment, employment growth has entered a strange phase rarely seen before. The number of people employed has stopped growing, yet the system has not officially entered recession. The curve has flattened. It is as if the economic engine has stopped accelerating, but somehow continues moving forward through inertia alone. But inertia does not last forever. At some point, momentum fades. And when it does, the slowdown becomes visible everywhere at once. Credit markets tighten further, debt defaults accelerate. Central banks respond the only way they know how, by injecting liquidity and expanding the money supply. That process has happened many times before in modern financial history. Whenever the system approaches collapse, authorities respond with enormous monetary expansion to stabilize the system. But each cycle requires more intervention than the previous one. The debt levels are larger, the markets are more leveraged, the system is more fragile. Which brings us back to silver. Silver is not just an industrial metal. It is also a monetary metal. For thousands of years it served as money across civilizations. When confidence in credit systems weakens, precious metals often begin behaving differently from other commodities. And sometimes the earliest signal comes from those closest to the physical supply, the producers. When producers stop hedging, they are effectively telling the market something. Whether consciously or unconsciously, their behavior reveals expectations about the future price environment. If they believed prices were going to fall significantly, they would hedge aggressively at current levels to lock in those profits. But they are not doing that. Instead, they are allowing exposure to the market to remain open. This creates an unusual dynamic inside the futures market, because if producers are not supplying short contracts, the burden of shorting shifts to financial traders. And financial traders do not have the same relationship with the physical metal that producers do. They trade contracts. Producers mine silver. When physical supply participants withdraw from the short side of the market, the balance of the system becomes unstable, and that instability can sometimes lead to violent price movements. Particularly if short sellers begin exiting their positions while prices rise, that situation creates what traders call a short squeeze. A short squeeze occurs when traders who bet against a commodity are forced to buy back their positions at higher prices as the market rises. Their buying pushes prices even higher, forcing more shorts to cover, creating a chain reaction. These events can accelerate extremely quickly, and when they occur in markets connected to broader financial stress, the consequences can spread far beyond the commodity itself, because silver sits at a unique crossroads. It is both a monetary metal and an industrial material. It participates in electronics, energy systems, manufacturing, and financial markets simultaneously. A major shift in the silver market, therefore, reflects pressures coming from multiple directions at once: industrial demand, monetary demand, currency instability, credit system stress, and energy costs. When all of these forces begin aligning, strange signals appear long before the full story becomes visible. Producer short positions collapsing to historic lows may be one of those signals. It suggests that those closest to the physical supply of silver are behaving differently than they have at any time in recent history. Whether they cannot hedge or simply refuse to hedge, the result is the same. The futures market is losing one of its traditional sources of supply, and when supply disappears from a derivative market built on leverage, the consequences can be dramatic. Because the silver market is not a small niche corner of finance, it is part of a much larger structure that connects currencies, commodities, energy, and credit. If pressure continues building across those systems simultaneously, silver may simply be the place where the first crack becomes visible. And if that crack widens, the signals currently appearing quietly inside positioning data could eventually explode into something the entire world notices. But by the time the public notices, the move will already be underway. That is how markets work. The biggest signals always appear first where almost nobody is looking. Inside the structure. Inside the positioning. Inside the behavior of those closest to the metal itself. And right now, that behavior is telling a story that the surface of the market has not yet fully revealed. The producers have stepped away from the short side. And when the producers stop shorting silver, the question is no longer whether something unusual is happening. The question becomes how long the system can continue functioning the way it always has. Because if the traditional hedging structure of the silver market is breaking down, the ripple effects will not remain contained inside the metal itself. They will spread outward into the entire financial system that depends on stable commodity pricing. And once those ripples begin moving through credit markets, currencies, and energy systems, the signal we are seeing today may eventually be remembered as the moment when something much larger quietly began. The strange behavior inside the silver market does not end with producer positioning. When a signal like this appears, it almost always connects to other unusual patterns forming across the broader financial landscape. Markets rarely move in isolation. Instead, they move in waves that ripple from one sector to another, revealing the hidden stresses of the system piece by piece. And once you start following those ripples, the picture becomes far more unsettling. Because at the same time that producer short positions are collapsing, something equally unusual is happening inside the gold market. Normally, when the price of a commodity rises, the number of open contracts in the futures market rises as well. Traders pile into the market, speculators add positions, liquidity expands, rising prices attract more participation. But sometimes the opposite happens. Sometimes prices rise while open interest falls. When that occurs, it means the rally is not being driven by new buyers entering the market. Instead, it is being driven by existing sellers exiting their positions. Traders who previously bet against the market are being forced to close their shorts at higher and higher prices. In other words, the market is squeezing them out. This type of move is one of the most powerful forces in financial markets. It can transform a slow upward trend into an explosive surge in a very short period of time, because every short position that closes becomes a buy order. And if enough shorts begin covering simultaneously, the buying pressure compounds, prices rise faster. More shorts panic, more positions close, and the squeeze intensifies. That is precisely the kind of pattern that has begun appearing in the gold market. Prices have moved sharply higher while open interest steadily declines. This is a classic signal that short positions are being forced out. And when gold begins experiencing short squeezes, the silver market rarely stays quiet for long. Historically, silver reacts with greater volatility. It moves slower at first, then faster later. When monetary stress pushes capital toward precious metals, gold typically moves first because it is the larger and more established monetary asset. Silver often follows afterward with much greater momentum. But silver also reacts to something else: industrial pressure. Unlike gold, silver is consumed by modern technology. It is used in electronics, energy systems, advanced manufacturing, and numerous industrial processes that depend on its unique properties. That dual identity makes silver extremely sensitive to shifts in the global economy. When economic growth accelerates, industrial demand pushes silver higher. When monetary stress increases, investment demand pushes silver higher. And when both forces appear at the same time, the results can become explosive. The unusual signals currently appearing across financial markets suggest that both forces may be building simultaneously, because beyond precious metals, the global economy itself is showing signs of instability. Energy markets provide one of the clearest examples. When measured against real money, rather than paper currency, oil has become extraordinarily cheap. A barrel of oil measured in gold requires only a tiny fraction of an ounce of metal. Historically, such low levels have only appeared during moments of extreme disruption, the early stages of major financial crises, global economic shutdowns, or massive credit contractions. Yet the world today is not officially in a crisis. Not yet. The economy is still functioning, markets are still open, supply chains are still moving. But beneath the surface, the ratios that connect energy to money are behaving as if something much larger is coming. That is why the oil-to-metal relationship matters so much, because energy is the foundation of every modern economy. Without energy, factories stop, transportation stops, agriculture stops, technology stops. Energy is the bloodstream of the industrial world. And when energy becomes extremely cheap relative to monetary metals, it often means that the currency measuring that energy is weakening. This brings us to the deeper problem, quietly developing beneath the entire financial system: the global credit structure. Modern economies are built on credit expansion. Governments borrow, corporations borrow, households borrow, banks lend against future expectations of growth. This constant expansion of credit creates economic momentum. It fuels spending, investment, and development. But credit systems contain a dangerous weakness. They require confidence. If borrowers believe the future will support their debts, the system continues functioning. Loans are repaid, new credit is created, growth continues. But if confidence begins to crack, the system can reverse with shocking speed. Debt that once seemed manageable suddenly becomes impossible to service. Defaults begin appearing. Lenders become cautious. And credit availability begins shrinking. The early signs of this process are already visible. Across several categories of consumer debt, delinquency rates have risen dramatically. Credit card balances that remain unpaid for extended periods have climbed to levels exceeding those seen during earlier financial crises. Auto loans are showing similar patterns. Student debt repayment stress is climbing as well. These numbers may appear abstract at first glance, but they represent something very real. They represent millions of households, reaching the limits of their financial capacity. When consumers begin defaulting on debt in large numbers, the effects ripple outward through the banking system. Lenders tighten standards, interest rates rise, borrowing becomes more difficult, and as borrowing slows, economic activity begins to weaken. Eventually, employment reflects that change. Employment trends have historically served as one of the most reliable indicators of economic turning points. When hiring slows and job growth flattens, recessions often follow soon afterward. But the current situation has produced a strange anomaly. Employment growth has stopped accelerating, yet the economy has not officially entered recession. The curve has flattened. The number of people employed has remained nearly unchanged for months, hovering at levels that appear stable but lack momentum. This has almost never happened before. In previous cycles, when employment growth stalled like this, a recession was already underway or about to begin. Yet the system today seems suspended in midair, like a runner who has reached the edge of a cliff, but has not yet looked down. Momentum alone is keeping things moving, but gravity eventually wins. When employment begins falling, the process often accelerates rapidly. Businesses cut costs, hiring freezes appear, layoffs begin, consumer spending weakens, corporate revenues decline, debt defaults increase further, and the entire credit system begins tightening simultaneously. This chain reaction is the classic structure of financial crises, and if such a crisis begins forming, the response from monetary authorities follows a familiar pattern. Liquidity. Massive liquidity. When credit markets begin collapsing, central banks step in to stabilize the system by injecting enormous quantities of newly created money. They purchase government debt. They purchase corporate bonds. They purchase financial assets to prevent market collapse. The intention is always the same: restore confidence and keep credit flowing. But each time this process occurs, it leaves a permanent mark on the currency system, because creating money to solve a debt crisis does not eliminate the debt. It transfers the burden into the value of the currency itself. Over time, repeated cycles of monetary expansion weaken the purchasing power of the currency. This is where precious metals begin playing their historical role. Gold and silver have served as monetary anchors for thousands of years, precisely because they cannot be created at will. They cannot be printed. They cannot be digitally generated. They must be mined from the earth through labor, energy, and time. That scarcity gives them a unique property in financial systems under stress. They become refuges for capital seeking protection from currency instability. And when enough capital begins moving toward those refuges, the price movements can become extraordinary. Silver in particular has a long history of explosive moves during periods of monetary disruption. Part of that volatility comes from the structure of its market. The amount of paper silver traded through derivatives is vastly larger than the amount of physical silver available for delivery. Futures contracts, options, and other financial instruments represent claims on metal that may or may not actually exist within the vault system. Under normal conditions, this structure functions smoothly because most contracts are settled financially rather than physically. Traders open positions, they close positions. Very few actually request delivery of the metal itself. But if confidence in the system weakens, more participants begin asking for physical settlement instead of cash settlement. That is when pressure builds. Because if too many contracts demand real metal at the same time, the exchange must supply that metal. And if the supply is insufficient, the system enters dangerous territory. Delivery delays appear, inventories shrink, and trust in the derivative structure begins eroding. Recently, unusual behavior has appeared in one of the smaller precious metal markets connected to the same exchange system. A situation emerged where the number of contracts standing for delivery did not match the number of deliveries actually occurring. Contracts remained open that should have been settled already. This kind of delay may have many explanations: administrative issues, logistical timing, or other technical factors. But in markets where physical delivery matters, even small irregularities attract attention, because they raise a critical question. Is there enough metal available to satisfy the contracts? Most of the time the answer is yes, but during periods of financial stress, that answer can become less certain. If participants begin doubting the availability of physical supply, behavior changes quickly. Instead of trading contracts casually, traders begin demanding delivery. Instead of rolling positions forward, they stand for settlement. Instead of trusting the system, they test it. And when enough people test a derivative system simultaneously, weaknesses can appear very quickly. This possibility is why the collapse of producer short positions matters so much. Producers represent one of the most important bridges between the physical silver supply and the futures market. Their hedging activity connects real metal production with financial contracts. If that bridge weakens, the balance of the market changes. Fewer natural sellers exist in the futures market. Short positions become concentrated among financial traders rather than physical producers. And if those traders suddenly need to exit their positions during a rising market, the buying pressure required to close those shorts can become enormous. This is how historic rallies sometimes begin, quietly. With positioning changes almost nobody notices. Then momentum builds. Prices rise faster, more shorts exit, liquidity thins, and suddenly the move becomes impossible to ignore. By the time the headlines appear, the largest gains are often already underway. The public sees the final stage of the move, but the early signals appear long before that. Inside the positioning data, inside the relationships between markets, inside the strange anomalies that only become obvious when you step back and look at the entire system. And right now, those anomalies are appearing everywhere. Energy ratios, credit stress, employment stagnation, rising debt defaults, short squeezes in monetary metals, delivery irregularities in precious metal markets. And perhaps most intriguing of all, the quiet disappearance of producer hedging in silver. Each signal on its own might not mean much, but together they form a pattern suggesting that the financial system may be approaching another major turning point. One where credit stress forces massive monetary intervention, one where currency stability becomes uncertain, and one where the ancient monetary metals reassert their role in the global economy. If that scenario unfolds, silver may not simply rise. It may move in ways that redefine how the market understands the metal entirely. Because the biggest moves in financial history rarely begin with fireworks. They begin with subtle signals almost nobody notices. Signals like the one appearing right now. A market where the producers, the very people who mine the metal from the earth, have stepped away from the short side. And when the producers stop shorting silver, the question becomes impossible to ignore. What do they see coming that the rest of the market has not yet realized? And that may ultimately be the most important question of all. Markets are full of noise, headlines, speculation, and short-term distractions, but every once in a while a signal appears that cuts through all of it. A signal that reveals how the people closest to the real metal are behaving. Right now, that signal is simple, quiet, and deeply unusual. The producers, the very entities pulling silver out of the ground, are not stepping in to cap prices the way they always have in the past. The short positions that once defined the structure of this market are disappearing. Whether it is because hedging has become too expensive, because the future structure is shifting, or because those closest to the supply believe the price ahead will be far higher than the price today, the result is the same. One of the traditional pressure valves of the silver market is fading away. At the exact same moment, credit stress is building, currencies are under pressure, debt levels are reaching historic extremes, and precious metals are beginning to move in ways that suggest something larger may already be unfolding beneath the surface. History shows that when monetary systems reach moments like this, the moves that follow are rarely slow and rarely gentle. They come suddenly, violently, and often long after the earliest warnings have already appeared. And the warning now sitting quietly inside the silver market is impossible to ignore, because if the producers will not touch short positions at these levels, then the real question is no longer whether silver is sending a signal in 2026. The real question is how powerful that signal will become once the rest of the world finally starts to see it.